The latest Warren Buffett's moves indicate an incoming collapse, and you need to know how to invest in this situation. Last year, he sold over 950 million shares of Apple and Bank of America, and Berkshire Hathaway is sitting on a record mountain of cash. Are we about to witness the next big market collapse? Here's the part most people miss: Buffett's not shouting warnings, but his secret moves are screaming them, if you know where to look. Today, I'll break down exactly what Buffett is doing differently this year, reveal why these moves hint at a massive repricing of US stocks, and show you how to invest and even thrive when everyone else is panicking. Hit that like button, stay with me, and by the end of this video, you'll have insight even most pros have missed. Chapter 1: The Cash Mountain. What's Buffett doing? As we've seen before, Berkshire Hathaway now holds over $334 billion in cash, the largest cash position in its history. When the stock market is booming, holding cash seems odd. Why isn't Buffett hunting for bargains? In 2024, Buffett sold more than $600 million of Apple shares, a holding he once called, "by far the best business I know in the world." He's also trimmed stakes in Bank of America, Citigroup, and avoided new big acquisitions. This isn't business as usual. Buffett's strategy is shifting toward maximum caution. Buffett isn't just some wealthy guy stacking bills for no reason. He's practically building a fortress of cash over at Berkshire Hathaway. Lately, his legendary cash mountain has been growing so fast it's got Wall Street buzzing. He's the only billionaire in the top 10 Bloomberg list that has grown yields in 2025. But, why is he stacking all this cash now, and what could he be seeing on the horizon? Chapter 2: Why is Buffett stacking cash? Many US stocks, especially in tech, are trading at all-time highs. The Federal Reserve has hiked rates to battle inflation, making borrowing costlier for everyone. From households to governments, debt is ballooning, and defaults are ticking up. GDP growth is slowing, some sectors are showing weakness, and there are whispers of stagflation. Buffett's not just stuffing his mattress for fun, far from it. The guy has this uncanny knack for sniffing out trouble in the economic winds. Right now, he's sending a silent signal: prices are too high and risks are rising. Instead of grabbing whatever looks shiny, Buffett's strategy is to hold off, build up his reserves, and wait for prices to drop. Remember 2008? He had the ammo to scoop up valuable assets while the rest of the world was in panic mode. That's what stacking cash gives you: a front row seat to buy great stuff on sale when everyone else is scrambling. When the time comes, he'll want cash ready to buy great businesses at once-in-a-decade discounts. Chapter 3: Other Warning Signs. Besides selling stocks in 2024, Buffett hasn't made any major acquisitions since before the pandemic, saying he simply can't find anything cheap enough. Berkshire is earning healthy, safe yields on cash parked in treasuries instead of risking more in overheated stocks. In the first half of 2024, Berkshire increased its treasury bills holdings by 81% year-to-date, reaching $234 billion in June. And, guess what happened? Today, April 21st, the S&P 500 PE ratio is 25.5. Calculating, we have an earnings yield of 0.0392, or 3.92%. And, the 3-month T-bill yield is 4.32%. This means, at present, investors receive a higher risk-free yield from short-term US government debt than from S&P 500 earnings. Of course, each one has its pros and cons. Treasury bills are nearly risk-free, while equities bear market and earnings risks but may offer price appreciation and dividends. But tell me, would you risk your money on stocks in the current situation and earn less than you would in government treasuries? And let's be honest, if the Oracle of Omaha is this cautious, there's gotta be some history behind it. Chapter 4: What happened last time? Now, let's take a quick walk down memory lane. It's not the first time Buffett's piled up cash and stepped back from the action. In the 2008 financial crisis, while most folks watched the stock market nosedive and panicked, Buffett had the dry powder to swoop in and grab deals for pennies on the dollar. Take a look at these CNBC articles. This is from 2009, where even dropping 32% in 2008, Berkshire has outperformed S&P. Detail, it says, since 1977, Berkshire has outperformed the S&P in 24 out of 32 years. This other one from 2023 says, Berkshire has a history of outperforming the S&P 500 during recessions, and performing especially well during bear markets, according to data from Bespoke Investment Group. Since 1980, Berkshire shares have beat the broader market over the course of 6 recessions by a median of 4.41 percentage points. There's a reason people rush to hear what Buffett's doing when whispers of a recession start swirling. His moves aren't a fluke. Each cash buildup, each defensive play, they're signals based on what happened before. But if you're wondering what this all means for you today, well, that's the million-dollar question, and the next piece might just change your perspective on how to invest going forward. Chapter 5. What does this mean? To complete the picture, I brought a few excerpts from Warren Buffett's letter to investors. Now pay attention, so we can interpret them together. In 2024, Berkshire did better than I expected, though 53% of our 189 operating businesses reported a decline in earnings. We were aided by a predictable large gain in investment income as Treasury bill yields improved, and we substantially increased our holdings of these highly liquid short-term securities. Over time, we think it highly likely that gains will prevail. Why else would we buy these securities? Though the year-by-year numbers will swing wildly and unpredictably. Our horizon for such commitments is almost always far longer than a single year. In many, our thinking involves decades. These long-termers are the purchases that sometimes make the cash register ring like church bells. In summary, he's only buying stocks if he thinks the prices will go up, of course. Right now, he sold stocks and bought treasuries because he believes prices are overvalued, or at least not good enough to justify the risk. But here's the thing, he states that this is a temporary move. Despite what some commentators currently view as an extraordinary cash position at Berkshire, the great majority of your money remains in equities. That preference won't change. Berkshire shareholders can rest assured that we will forever deploy a substantial majority of their money in equities, mostly American equities, although many of these will have international operations of significance. Berkshire will never prefer ownership of cash-equivalent assets over the ownership of good businesses, whether controlled or only partially owned. He still believes equities will prevail in the long run. If so, these moves are being made to help Berkshire reallocate its portfolio once the time is right. Now, let's take a look at what we can learn from Warren's moves. But first, if you found this breakdown helpful, don't forget to like, subscribe, and hit the bell so you don't miss the next update. You can also share this with your friends who recommend meme coins or think it's time to buy a rental property. They definitely need to hear it. Always remember that everyone has an investment profile, a different level of risk aversion, and their own way of analyzing investments. You just need to focus on what best suits you. So, here are the things we can learn from Warren Buffett. Building up your own cash reserve can give you the flexibility to act quickly when the stock market serves up unexpected bargains. Don't feel pressured to chase expensive stocks. It might be important to focus on resilient sectors, consumer staples, healthcare, utilities. Look at short-term government bonds, high-yield savings, and defensive ETFs. If markets tumble, that's your window to buy quality at a discount. Simple rule: be fearful when others are greedy and be ambitious when others are fearful. Chapter 6. What's next? So, does this mean the collapse is guaranteed? Of course not. Predicting market crashes with certainty is impossible, even for Buffett. But when the world's greatest investor is sending a caution signal, it pays to listen. What are you doing to prepare for a possible recession? Do you believe your country will thrive in the next 5 years? Share your thoughts in the comments. As a good economist, I will analyze the main economic consequences of the recent changes in the most talked about countries. So, what's the final takeaway? Well, don't just sit there and watch Buffett stack cash. Use his strategy as inspiration for your own investing moves. Ask yourself, is your current investing strategy prepared for a possible recession, or are you just crossing your fingers and hoping for the best? If you're scratching your head about how to invest during a wild market or right before a recession, take this page from Buffett's playbook. The patience to hold cash, and the discipline to wait, lets him make bold bets when others are panicking. And hey, if it feels overwhelming to balance caution and opportunity, that's totally normal. The best investing strategy isn't always about picking the next hot stock, it's about staying prepared, thinking long-term, and making choices that fit your goals. Practical advice? If you see patterns repeating, like Buffett building cash, trimming risky positions, or eyeing bargains, you might want to rethink your own investing strategy. Watch for moments when everyone else is panicking, because that's often when opportunity knocks loudest. Remember, history has a way of rhyming, especially in the wild world of the stock market. So, when someone asks, what's Buffett doing, the real answer is, he's preparing, sharpening his strategy, and waiting for the perfect pitch. Shall we become truly wealthy together? Stay smart, stay safe, and invest with wisdom.